What's up, everyone? It's Karthik with MoneyVest. So markets here very much flat, and this was the calm before the storm tomorrow. So tomorrow at 8:31 a.m. Eastern, we will have a much better idea and an understanding of the economy, the labor market. So the jobs report is due for tomorrow at 8:30 a.m. Eastern. I will be live at 8 a.m. Eastern, so make sure that you tune in for our live stream to take a look at the market's live reaction to the jobs report. And every single economic data point is actually going to become more and more important for the market because the Federal Reserve is really going to be looking at these data points very closely. As data dependent as they are, they're going to be basing their decisions for interest rates off of these reports. So make sure that you tune in to take a look at the market's reaction and what is the expectation from the Federal Reserve moving forward. So the NASDAQ today did gain a little bit over 25 basis points. We had the S&P 500 down about 30 basis points, and the Dow Jones down about 0.5%, a little bit over 200 points on the day. It's not very often you actually see the NASDAQ pushing higher and S&P 500 not pushing higher. So that is in itself a very clear signal that technology saw a pretty significant gain, and other parts of the market, other sectors actually sold off quite aggressively enough to make the S&P 500 down on the day, despite technology having a pretty decent day, pushing higher with Tesla, Nvidia, Google, Apple. A lot of these companies were higher on the day. I also want to mention that I sent out an update for our options portfolio for the second week and made some adjustments, and really this is a whole transparent breakdown of my options portfolio. So make sure that you check that out if you want to join and be a part of our MoneyVest community. There is a 16% annual discount, and you will get every single week option trade alerts, investing trade alerts, as well as options portfolio updates, and access to our MoneyVest website and our Discord as well. So link's going to be down below. We'd love to have you on board. So this right here, there's 4 more spots left for the month of September. Again, if you have any questions, please feel free to let me know. And also do subscribe to the channel. Share this video with your friends and family. We'd love to have you on board. And again, if you find value, make sure that you subscribe. 34% of you guys are not subscribing, but are still watching the content. So I would really appreciate that if you can get that number up to 100%. So all of you guys watching, ideally, you should be subscribed. Okay, so this is insane. This is crazy because Nvidia obviously started selling off as soon as there was a report from Bloomberg that the Department of Justice has subpoenaed Nvidia related to some antitrust investigation. And Nvidia kind of cleared up those doubts, denying that it had not received the subpoena. We have inquired with the U.S. Department of Justice and have not been subpoenaed. A spokesperson mentioned who is in direct contact with the press. And nonetheless, we are happy to answer any questions to regulators that may have about our business. And the company also said that it wins on merit, and the customers are free to choose whatever solution is best for them. I honestly don't even know what to believe anymore because this is insane. This is crazy. How is Bloomberg not taking any responsibility for false reporting about Department of Justice sending out a subpoena to Nvidia? This is crazy. This should not be allowed because they're literally just putting out a hit piece on Nvidia, kind of spooking a lot of investors, making them scared. And then the next day they're like, you know what? Oh, oops, we made a mistake. It wasn't really a subpoena. It was just a letter asking for, I think it was also asking about the recent acquisition for another company. But other than that, it was literally nothing. And Nvidia had to, again, come out and deny that report. And it's really going to come down for me tomorrow. Tomorrow's literally the expiration for the put that I have from last week. So that's the options portfolio update. I sent out, an alert last Friday for this particular week on Nvidia. And it's really going to come down to the final day because Nvidia, right now, as you'll notice, closed at just over $107.21. Broadcom is selling off a little bit over 7% after it reported actually a double beat, and also the guidance was pretty strong. But Nvidia is down about $106.40. It's going to come down to the final day for my option trade on Nvidia. And quite honestly, I don't actually mind getting assigned my 600 shares around these prices because Nvidia's call premiums are actually pretty solid. So if I do end up getting assigned on Nvidia, I would most likely be selling at the money or slightly out of the money calls that are paying $2 to $3 per contract, which is going to translate over to well over $1,500 to as much as $2,000 for the next week, which is, again, a lot of bread that I can capitalize on if NVIDIA has a sideways or a down week next week. Even if it does push higher, I receive the premium regardless. And that's how strong the premiums are. That's how juicy the premiums are for NVIDIA. So tomorrow is going to be a pretty good day, in my opinion, regardless of what happens with the jobs report. If NVIDIA sells off, then again, I will get those shares assigned. And if NVIDIA doesn't, then I'll keep the premium and then I'll repeat that process of selling puts once again until I get those shares assigned. And then, of course, I'll switch that strategy over to the back half, which is selling calls. That's part of the entire wheel strategy. I've done that with Tesla. Now it's time to take advantage of the juicy premiums that NVIDIA has to offer. So stay tuned. If you are part of our Discord, wait for those alerts sent out tomorrow. And again, the portfolio updates over the weekend as well. So coming over to Magnificent 7, we had an inflow of about $146 billion. A lot of that coming from Tesla. Tesla was up a little bit over 4.9, almost 5% on the day. So very strong gain, almost up to $700 billion in market cap. $34 billion inflows on the day today. Amazon also a little bit of an unsung hero here. $48 billion inflows for Amazon, up over 2.6%. And then NVIDIA up almost 1%, 24.5%. Then we had 23.2 billion from Apple and then 10.4 billion from Meta. The only company that was down today was Microsoft. It's actually quite crazy that Microsoft is trading below its moving averages across the board. You'll take a look at that in the technical dashboard here in just a minute, but $146 billion inflows across the board for Magnificent 7, and the S&P 500 actually had outflows of $141 billion. So despite Magnificent 7 seeing over $140 billion of inflows, the S&P actually sold off and was down over $141 billion. So what does that tell us? That means the rest of the Magnificent 7 companies saw outflows of $280 billion, meaning that the other 493 companies saw $280 billion worth of outflows, right, for the S&P 500 to be down $141 billion, despite Magnificent 7 pushing higher. So if you really take into account some of these big losses, I mean, Berkshire Hathaway, $30 billion, Eli Lilly, $30 billion. So they were down about 3.6, 2.8% respectively. So you've got a few more companies like McKesson Corporation that was down a little bit over 9.9%, ticker symbol MCK. So if you come over to MCK here, it was down over 9.9%, losing a little bit over 7.3 billion. And on goes the list here for all the companies that were down quite significantly, despite Magnificent 7 pushing higher. So if you take the negative numbers here, come all the way down here, we got $337 billion actually in losses for a total of 368 companies selling off. And then the companies that were actually pushing higher, we had a little bit over 125 companies pushing up closer to $200 billion. So 197 minus 300 something, $300+ billion, so you get a net loss for the S&P 500 of $140 billion, despite Magnificent 7 pushing higher on the day. So that was actually quite interesting here. And we actually also witnessed quite a large order coming in for NVIDIA towards the market close. So 3 million shares picked up towards the pretty much the last second of market close here, 4 p.m. and 6 seconds here. Large buy order coming in for NVIDIA on the day today, so on September 5th, 2024. Something to keep in mind for this stock as well. Now, coming over to our market snapshot, and this is where we are with respect to a dip, a pullback, correction, or a bear market. You can also access this on our MoneyVest platform, but Amazon, for example, down over 11.5% still from its all-time highs in a correction. Apple's back in a pullback. Meta was holding up really well for a really long time. It was well within a dip, so less than 5% from its all-time highs, but it's now in a pullback. And then we got Broadcom in a correction. Most likely it's going to open in a bear market tomorrow, considering that it's selling off over 6% after hours right now. And we got Advanced Micro Devices in a bear market, NVIDIA in a proper bear market, Microsoft's in a correction. Then we got Google in a correction, down almost 18%, and then Tesla also is in a bear market, although that situation's been improving a little bit as Tesla has, moved back higher really, really well. ADP non-farm payrolls, 99,000 jobs added in the month of August. Consensus was 140,000, so that was a significantly lower number compared to the consensus. And this right here is what traders are pricing in. The volatility is going to be high because the options market right now is pricing in for a 1.1% move in the S&P 500 in either direction. So we don't really know what that direction is going to look like, but 1.1% is the expected move from the S&P 500 going into tomorrow because of the unemployment rate. And Russell 2000 is expected a swing of 1.8%, and the NASDAQ is expected to move about 1.4%. Again, directional bias is unknown, but economists are expecting 161,000 jobs to be added in the month of August. So jobs report holds the key to size of the Fed rate cut, forecast for 161,000 new hires and 4.2% for the unemployment rate. It's expected to come down from 4.3, and jobless claims to drop to 8-week low. Hiring has been slowing, but layoffs aren't rising, and ADP says businesses added just about 99,000 new jobs in the month of August. Economy grew again in August. ISM finds, but momentum has faded a little bit as well. So these are the expectations. Consensus 160,000, 4.2% unemployment rate, 136,000 private payrolls, down 2,000 in manufacturing payrolls, participation rate at 62.7%. And the average hourly work hours or earnings up 0.3% month over month and 3.7% year over year. So again, we'll be live to cover all of these numbers, which are going to be the market moving event. And at 8:31 a.m. Eastern, we will find out. It's going to become very obvious whether we're getting a 25 or a 50 basis point hike from the Federal Reserve. So by 8:31 a.m. Eastern, it may be obvious whether it is 25 or 50. This was Krishna Guha, head of global policy and central bank strategy at Evercore. An economist surveyed by Wall Street expect 161,000, unemployment to tick down to 4.2% from 4.3. And Guha said the unemployment rate will likely be the first among equals in driving the market reaction. And a relatively good report with unemployment going down to 4.2% or lower delivers a 25 basis points rate cut unless payrolls are notably weak. And a relatively bad report with unemployment accelerating to 4.4 delivers a 50 basis points unless payrolls are spectacularly strong. A middling read on unemployment unchanged from July at 4.3%. Return on payrolls with a boogie, probably 150,000, but possibly nearer to 125,000. So it's kind of a balancing act that if it comes in too strong, jobs report, it's not good for the market. If it comes in too weak, it's not good for the economy. So we have to kind of find that middle ground and be a little bit more balanced, because what the markets are really looking for is rate cuts and a soft landing at the same time, right? So rate cuts with the lack of a recession. So in other words, we want to see rate cuts, but we don't want to see a recession. So that's what the markets are really, that's the sweet spot. The markets are going to be targeting that. We don't want to see a too strong or a too weak jobs report. We want to see something that's good for the markets, something that's stable, something that allows for the Federal Reserve to continue on those rate hikes, the rate hikes, for the market to expect rate cuts, but at the same time, not elevate those fears around a recession in the US. So that's where we are with this jobs report. And it's been a pretty decent split between 25 and 50 basis points from the federal funds rate from the market. So 59% probability that we're going to see a 25 basis points and a 41% probability that a 50 basis points is still possible. Now, coming over to this chart, this is also very interesting. So after we see a first day return of negative 2% or more, the markets on average and median basis are higher rest of the month, whichever month that is. However, for the month of September, though, it's not been great. So if I really highlight the months of September 1974, then we've got September 2000, then we've got September 2009, then we've got September 2015, and then we've got September 2024. And the reason why I'm highlighting this chart is because we did see a 2% sell-off in the first day of September, which was Tuesday, the Tuesday after the long Labor Day weekend. And what's going to be that return for the entire month, right? That's the question mark. But in the past, you'll notice that September, once we see over a 2% sell-off in the first trading day, 9.9% sell-off. 4.2% in the first trading day of September in 2002, 7.1% sell-off. September of 2009 was perhaps the only time, or probably the second time, when we saw over a 2% sell-off on the first trading day of September, and we closed the month up almost 6%. And in 2015, we were down over 3%, and then we closed the month basically flat. So we've got about a 50% chance, I guess. Out of 4 times we witnessed this, twice we were higher in the month of September and twice we were lower. But that lower months, the brutality of that sell-off is far severe than the gains that we have witnessed, because the gains are really just about 3% on average versus the 9% on average sell-off that we have witnessed between these two scenarios, right? I could say 8% average between these two scenarios over here. Something to keep in mind. But if you consider all the months that the markets have been down in the first trading day, down about 2%, on average and median, we are up over 3.4% with a 72% probability that we're going to be higher. But I think September seasonality is more something that we need to be focused on at the moment. So this right here is where we are with the MoneyVest dashboard. We are at 3.62 for the MoneyVest index. We've come down from 405 down to 3.6. So that's good to see. And volatility reading is now back under 20. The contango level is at 4.78%. The PCC ratio down to 0.857. A lot of stocks are now back trading below their moving averages, especially this 20 SMA, something that we have discussed on the channel before. And if you come over to this chart, you'll notice how quickly this has reverted back lower. And this is exactly what we talked about in our previous updates when I was giving you guys some warnings of why this is a technical indicator that we need to be aware of and something that is getting overheated right now. So I would not be surprised to see a bit of a technical pullback on the markets. And that's exactly what we witnessed as this index started to rotate back lower. So we're now down to 59.6%, so a little bit under 60% right now, as we are down almost 3% on the S&P 500. And the PCC percentile, 28.5. RSI readings come down to 48, so a little bit more on the neutral zone. Now, this is also that I think is very, very important to take note of, because what we have witnessed now is energy, healthcare, materials, industrial. So those are also a few sectors that are hurting short term. Energy is definitely down across the board, on the back of these oil prices that are coming down. So with the softening demand, oil prices continue to plummet. So if you come over to the crude oil here, you'll notice a severe decline in the month of September, down over 5.8%. And on the daily time frame, it continues to break down very critical areas of support, down under $70 a barrel, which is resulting in, of course, the selling pressure for energy stocks as well. Real estate, surprisingly doing really well. You'll notice that it's actually up across the board on all those moving averages, and a few more sectors like utilities and staples are still up across the board for all their moving averages. And gold pushed up, TLT pushed up. There are also 2 sectors that are pushing higher on all accounts. So these 4 right here, gold, TLT, XLU, and XLP, those are the 4 areas of the market that are trending upwards very, very well. There's a technical momentum behind these 4 parts of the market. And now you'll notice the S&P, the NASDAQ, the Dow Jones, the Russell, the NASDAQ 100. So mostly the equities over here are all struggling, trading below their 5 SMA, 9 SMA, in some instances 21 and 50 SMA as well. And the NASDAQ 100 also down on the 100 simple moving average. XLK, which is technology, communication services, and financials, all 3 of them struggling, with energy, as I already pointed out, doing really bad. And the dollar index has also rotated back down, very similar to energy, down across the board on all of their moving averages. Discretionary, XLY, is a little bit of a wild card because we're seeing Tesla kind of lift that momentum. Tesla and Amazon kind of fall under discretionary. So if you come over to how Tesla and Amazon are doing over here, it makes sense, right? Because Amazon and Tesla both are above their 5, 9, and 21 simple moving average. Tesla, in fact, is actually up above the 50, 100, and 200 as well. Because of that momentum, Tesla is across the board is the only Magnificent 7 stock right now that is actually trending upwards across the board on all moving averages. And Amazon also on a short-term basis above its 5, 9, and 21 SMA. So these 2 kind of falling under discretionary is one of the reasons why discretionary over here is doing so well. It's up across the board on all accounts. So there is momentum for discretionary also coming in. To my surprise, Microsoft is actually one of the worst performing Magnificent 7 stocks right now, trading below all of its moving averages on the 5, 9, 21, 50, 100, and 200 simple moving average. And Apple, Nvidia, Google kind of fall under the same bucket. It's only really the 100 and the 200 that are kind of battling on. And Meta here, short-term trend has reverted back lower, trading below some of those moving averages. So some things to keep in mind. And you can see that Amazon and Tesla here. So again, a little bit more on the cyclical or discretionary side, pushing higher. And Eli Lilly selling off. Healthcare was down. Energy was down. Financials were down. Industrial were down. So again, all those sectors sucking that liquidity out, moving more towards technology. So Apple, Google, Meta, Nvidia, Tesla, and Amazon, and Microsoft definitely underperforming its counterparts. So one more thing I want to point out is the uninversion of the yield curve. We talked about this during our live streams with Charlie Belio, also mentioning the longest inversion of the yield curve of 783 days. And it's really been times like these when the uninversion happens is when the probability for recession is also elevated, because it's not so much about the inversion, it's the uninversion that's resulted in recessions over in the US. So is this time around, are we going to see something similar? Of course, time will tell, but just want to put this on your radar that we are now finally uninverting after a very, very long time for the yield curve, right? And this is going to be the money market funds and the federal funds rate. This was a study from Bank of America Global Research suggesting for the cash, which is $6 trillion sitting in money market funds, are not going to be leaving the money market funds unless interest rates come down to 2%, below 2% is what they're suggesting for. So money market funds, essentially inflows do tend to slow after the Federal Reserve starts cutting interest rates, but outflows from money market funds also have been uncommon unless rates fall below 2%. And the reason for that is because you've got inflation pegged at 2%, that's the target. And if interest rates are above 2%, money market funds, pension funds, sovereign funds, whoever is holding up assets in money market funds, they have no problem keeping it there if they are able to make 3%, 4%, 5% on their uninvested cash simply by keeping it in money market funds. The moment those interest rates drop below 2% is when they are now actually losing purchasing power against inflation, because now inflation all of a sudden is above the interest rates. So on a real basis, on a net basis, you're actually making less money just because you're earning 1%, 1.5% on money market funds, but inflation's at 2%, your actual purchasing power starts to go down. And that's when they actually start seeing outflows over to some of the more riskier asset classes to generate a higher yield in order to beat inflation. As I mentioned before, I think it's really important for everyone to understand. I remember this book called The Capital Allocators by Ted Seitz, and he essentially talks a lot about portfolio managers and capital allocators from all over the world managing hundreds of billions, if not trillions of dollars. And one of the most important lessons that I learned from that book is that everyone is playing a different game, right? So not everyone is playing the same game, meaning that you and I could be playing a completely different game. We might still be investing in the markets and trading the markets, but we may have a completely different game that we're playing with our risk tolerance, our time horizon, our investment goals, our objectives, our risk tolerance, everything. And so in that book, in Capital Allocators, he talks about not everybody's goal is to beat the S&P 500, okay? There's a lot of portfolio managers, there's a lot of capital allocators that are getting paid a lot of money just to beat inflation. That's it. All their goal is to beat inflation, just the 2%, 3% per year. And these could be pension funds. These could be endowment funds from college universities. And these are all funds that are constantly utilized, right? Every single year, they're utilizing those funds for the betterment of their community, for their infrastructure. And so really, they don't want to risk or take on too much risk in hopes of getting a higher yield. Because one of the things that we have to understand is the higher you go on the yield curve, the more risk you're going to be taking, right? If your goal is to make 8% versus 20%, those are two very different risk profiles. Versus if your goal is to make 2% or 4% or 10% or 20% or 50%, all those targets are going to have a very different risk profile. And they're going to go from like moderately risky or very less in risk to all the way up to very, very risky, right? So the higher you go in search of yield, the higher that risk is going to be. And so everyone is playing a different game. And for a lot of capital allocators, the goal isn't just to beat the S&P 500. It could very simply be to beat inflation and keep that portfolio growing at a very normal standardized rate of 3%, 4%. And that can be accomplished by simply owning the treasuries, right? The bond market is a pretty good place to park cash to generate some nice returns while not taking on any risk whatsoever. That's why it's called the risk-free rate. So that's where we are for this. And after its August sell-off, the US dollar also is potentially facing more downside risk. This was from Bank of America Global Research as well, as they are expecting more potential downside for the dollar. And this is the potential divergence that we're seeing for S&P 500. And every time we've seen that, the markets have seen a nice little dip of anywhere from 3 to 4%. And right now we are seeing this once again, which is that negative divergence that we are witnessing, and the markets have the potential to once again see a little bit of a pullback as well. And total assets on the Federal Reserve's balance sheet has come down to $7.1 trillion. There's been a lot of liquidity that's been sucked out of the market as part of Federal Reserve's quantitative and more restrictive policy stance, and they've gone from $9 trillion down to $7.1 trillion. So $1.9 trillion has been rolled over from the Federal Reserve's balance sheet. And again, want to remind everyone that Tom Lee's already advised caution for the month of September, expecting a 7 to 10% pullback possibility, with some market turbulence also on the cards for the month of September. Now, coming back over to the technical analysis, volatility here coming down over 6.7%, so back under 20. And again, tomorrow it's really going to come down to the unemployment numbers for us to better understand what is the Federal Reserve going to do. But coming over to S&P 500, on the 30-minute time frame, we continue to consolidate sideways. So we broke down from that support as we discussed in our previous update. And of course, we continue to slide lower and lower highs and lower lows now. And the next support really is going to be down to as much as 5,400 with a very strong resistance sitting 5,575. And that's exactly what we're going to be watching going into tomorrow's print for unemployment. QQQs, on the other hand, we talked about this potential breakdown for the NASDAQ 100, broke down below 468, and the next target is going to be 454. I think that's exactly what everyone need to be mentally prepared for, that it's possible that we do see that level from the NASDAQ 100. It's going to put us down, I think, a little bit over 8% from our all-time highs, just over 9.7% actually from our all-time highs. We're currently down over 8% from all-time highs, so we're going to be in a correction territory once again if you get down to 454 or lower. And resistance is going to be 468, and we'll see what the jobs report have in store for us for tomorrow and how the markets react to those unemployment numbers. Coming over to individual stocks, starting with Apple, and Apple here also consolidating sideways, and up over 69 basis points on the day. But this right here is a very strong area of support that we have discussed in our previous updates. Support level is going to stay up roughly around 217. Resistance all the way up to $236 for Apple. Amazon had a very nice day, pushing up over 2.6%. Support level is going to stay put right here, 173, and resistance all the way up to $189. And then maybe one more resistance to keep in mind in and around that $180 per share for Amazon. Tesla, phenomenal day. I did a video on Tesla and Palantir. Tesla releasing a lot of really new cool updates on FSD with their new system. Smart Summon as well. So resistance is going to be staying put right there at 233. Support level all the way down to $208 for Tesla. So nice little momentum higher. I did sell calls on Tesla because I'm expecting a little bit of a pullback here from those 260s, 270s resistance. There's a lot of supply for Tesla sitting in and around those prices. So we'll keep a close eye on how Tesla does, but support level is going to stay at roughly $208 for the company. Coming over to NVIDIA, and NVIDIA, tomorrow is the day. Tomorrow is when my put expires, and we'll see if I have to roll that contract out, if I'm going to let it expire in the money, or what happens if it goes out of the money. So tomorrow is going to be the day. I'll keep you guys updated. And again, if you want to get access to all the live alerts, trade alerts, options, portfolio updates, all the website access, Discord access, links going to be down below. We'd love to have you on board, and I'll open up a few more spots if you are interested in joining. Just message me if you have any questions, and I'm more than happy to help. And again, we have over 1,000 traders, investors you can engage with in our community, and all of them are there to just help you, support you in your trading and investing journey as well. NVIDIA, on the other hand, support level $96 all the way up to as much as a resistance of $118, and we'll keep a close eye on how it trades tomorrow. Broadcom definitely selling off after hours, and NVIDIA is down another 60 basis points right now as of the time of this video. Advanced Micro Devices continues to trade inside this downtrending channel. Lower highs and lower lows. Support level is going to stay put at 121, 122. Resistance all the way up to $142 for Advanced Micro Devices. Talking a little bit about PayPal, and PayPal here on the day was down about 80 basis points. This is going to be that support level inside this green rectangle, sitting roughly at 68 to as much as $70 per share, all the way up to as much as $76, $77 for PayPal. It's been a very nice run up for the company, however, overbought on the RSI and the MACD as well. Visa is also working for a faster checkout system using straight banks. So that's a little bit of a catalyst that's, I think, resulted in a very nice rally for Visa. However, as pointed out, the overbought conditions on the RSI and the MACD, it's not unusual to see a little bit of a pullback for Visa from those levels. Support level is going to stay put at 270 down to as low as $265 for the company as well. Coming over to ENPH, and Enphase here continues to pull back. Support level inside this green rectangle. I will be looking at selling some puts on Enphase as well if it continues to roll over and if the premiums are juicy enough for us to take advantage of those puts. Resistance is going to stay put up to $124 for Enphase at the moment. A lot of consolidation sideways in that range for this company. Costco, on the other hand, also just consolidating sideways and pushing slightly higher. Support level is going to stay put at 873. Resistance all the way up to $893. Just a little bit under $900 for Costco. Coming over to Meta Platforms here, and Meta continues to roll over a little bit from its resistance of 541, although higher on the day. This right here has been a lot of consolidation sideways in that range with a huge area of supply sitting at 540. Support level 458 down to $420 for Meta Platforms. And then finally coming over to Netflix, Google, and Microsoft. Netflix here consolidating sideways. We're going to extend that a little bit further. Resistance is going to stay put at $700 with the support level close to 661. If it does end up, let's say, breaking down below this level, which is a possibility, next target is going to be closer to 615, kind of aligned with this higher low for Netflix moving forward. And finally, we come over to Google and Microsoft. Google continues to break down from this bear flag. Next support inside this green rectangle, sitting roughly at 153. Resistance all the way up to as much as 176, 177 for Google. And finally, we come over to Microsoft with a head and shoulders fully forming really well. Support level and inside this green rectangle is where the neckline is going to be. Sub $400 is a possibility for Microsoft. And like I said, it's been one of the more underperforming stocks, both technically and from a price action standpoint. So support level right about here at 395 down to as low as 364. So hope you all enjoy this video and a complete update on the markets. Tomorrow is the big day. Get ready for 8:30 a.m. Eastern. I will be live to cover those entire numbers, and we'll take a look at the market's reaction and evaluate and discuss what that means for the market moving forward. So hope you all enjoy this video, found it helpful. Make sure that you drop a like, subscribe to the channel. Don't forget to join our Discord and our Patreon if you are interested in getting access to our website, our Discord, our alerts, our portfolio updates. Everything's going to be included. And as always, happy investing. I'll see you all in the next video.